In this video, we're going to be touching what is called trading tools, and we can also call this indicators. So an indicator is a mathematical calculation based on security, historical price, and volume. The result is used to predict future prices of assets. Indicators can help traders identify certain signals and trends within the market. When I say signals, I mean it can show you overbought region, oversold region, support, resistance. And I want you to know that indicators are not enough confirmation to take trades in the market. They are solely for extra confirmation after the standard price action analysis has been done. Before we get into indicators, I would like to show you overbought region and oversold region and what they mean in the market. So to understand this better, I would like us to slide into our TradingView platform. So now we already know what support is, we already know what resistance is. So this is BTC USDT chart, and we want to do some analysis on this particular price action. We said earlier that indicators are not enough confirmation for us to take trades. They are only extra confirmation after you must have done your price action analysis, right? So we're going to be doing price action analysis first, and I'm going to be showing you what oversold region and overbought region are. So right now, we already know that this region is resistance, right? And then we can see head shoulder formation around here, and then there was a retest of that region after it has broken it here. Do you understand? I hope you guys can remember our patterns, trading patterns, chart patterns. So right now we are looking for a break in market structure. We already had a break in market structure around here because our price formed a lower low, right? We already got high here, we got a lower high here, and then we got a lower low here. Now we just formed another lower high. So what do I mean by a break in market structure? It means that when the price is going down, you know it is forming lower highs. If there's any point where the price stops to form lower highs and it starts to form higher lows, that will be a break in market structure. So that's what we'll be looking out for. So when you're in a downtrend and price is forming lower highs, when price stops to form lower highs, then there will be a break in market structure. So that means there's going to be a change of trend very soon. So if it's uptrend and price has been forming higher lows in the market and then it starts to form lower highs, it means there's a break in market structure of the uptrend. So for example, in this region now, we have been having lower highs. This is a lower high, this is a lower high. So the only time I can say there's a break in structure is when we turn this resistance to support. So when price goes above it and it starts acting as support, then I can say there's a break in market structure because we have been having lower highs, and once we stop to have lower highs, then there's a break in market structure. So let's say price broke through and then retested it as support. It means that the new market structure right now is higher lows that are forming, which represents uptrend. So that's a break in market structure. So once we break this resistance and turn the resistance to support, it means we're already having higher lows. So this is a low, this is higher low, and then a new higher low will be forming. Do you understand? So that's a break in market structure. So now we already analyzed that right now we don't have any break in market structure because we are still forming lower highs. We are still forming lower highs, which signifies downtrend, right? So what do we mean by oversold and overbought region? Overbought and oversold region are shown on indicators. For example, I'm going to show you my RSI. This is my RSI. This is what it looks like. I'm very sure you must have done the setting of your RSI in our previous lesson on setting up TradingView. So if you've not done it, we can do it again. So RSI, the length should be on 14, the source should be on close. For style, you can leave it on purple. The RSI should be purple. The upper band should be 70, while the lower band should be 30. The background, leave it on and then click OK. So what this is showing us is 70 represents overbought. Do you understand? So when RSI is going above 70, it means that particular asset is now selling expensive. When you say overbought, it means that when buyers have been buying a particular asset and they've been able to take the price up to a certain level where they can continue to push the price up. So it means the price of an asset is now selling very expensive and no one in the market is willing to buy at that price level. And once there's no demand in the market and there is more supply than demand, price will drop. So at this point, when the RSI was getting above 70, you can see this is our 70 line, that's the upper band. So when it was getting above 70, this is showing us that the market is already getting overbought. It means price will soon start dropping. So the RSI gave us a signal around here. This was where the RSI gave us a signal that we're already getting to overbought level. So it is high time we start leaving our position. Maybe we start selling in the market because price is getting too expensive. So anyone that has this particular asset should start getting ready to sell. That's what RSI was telling us here, because it was already above 70. So what happened to the price when it gave us a signal? So let's say after giving us the signal, we sold. It first consolidated for a while, then it started dropping. So RSI already gave us the signal about 3-4 days before the price started dropping. So that's what RSI does. You don't use it to do your analysis. It's just a form of extra confirmation in the market, so as other indicators. And when it comes to oversold means sellers have been selling a particular asset to a price level where it is too cheap for them to keep selling at that price point. So when an asset is selling too cheap, everyone with that particular asset will like to leave the market. So let's say I bought an iPhone for 200,000 and iPhone is now selling for 130. Definitely I'm not going to sell my iPhone. I want the price to go up first, so I'm going to be leaving the market. And once there is no supply in the market, there will be more demand than supply. More people will want to buy because not so much of that product is in the market anymore. So at that point, we can call it oversold level because they've sold it to an extent that it is too cheap. So oversold region is represented by 30. So here, anytime price is going below 30, anytime the RSI is going below 30, it means the price is at oversold level. And at that point, you want to be looking for areas to buy in the market because that particular asset is now selling cheap. Do you understand? So it's just a direct opposite of overbought. Overbought means the asset is selling too expensive. You should get ready to get rid of the product. You should get ready to start selling the product because the product is now expensive. If it's oversold level, it means you should start getting ready to buy that product because it's now selling very cheap. So that's what oversold and overbought levels are. Remember that overbought is when price is expensive, when an asset is selling too expensive and it is time to get rid of that product. And oversold is when an asset is selling too cheap and you want to buy into that product. Do you understand? You don't want to be selling at oversold and you don't want to be buying at overbought. Remember that. I said before you use indicators for confirmation, you have to do your price action analysis, which we did. We already checked the market structure, we already checked the support and resistance, we already checked our trend and other necessary stuff in the market before we get into indicators. So indicators are just extra confirmation for trades, for taking trades in the market. So the first indicator we are going to be talking about is RSI, which we already talked about a few minutes ago. So RSI is a momentum oscillator that measures the speed and change in price movement. It determines how strong and how weak a trend is. So for RSI, there's a midpoint which is 50. And there's the upper band which is 70 and there's the lower band which is 30. Remember in the illustration I gave, I said the 30 represents oversold, and oversold is a region where you want to be buying into the market, while 70 represents overbought. Overbought is when an asset is selling too expensive, and then if you have that particular asset, you want to get rid of it. Do you understand? When RSI is getting way above 70, it means it's getting overbought and there's no more strength in the market for the buyers to continue to push the price up. So let me say that again. For 70 RSI level, it means that there's a lot of strength in the market for the bulls. Once we start getting above 70, it means there are no more buyers in the market to continue to push the price up. Do you understand? So at overbought level, you want to be thinking of selling a particular product. Sell it if you have it. Do you understand? But for the 30 RSI level, it represents oversold. An oversold level is when a particular commodity, asset, or coin is selling too cheap. When RSI level is already getting below 30, it means there are no more sellers in the market to continue selling to push the price lower. So most likely you are going to be expecting a reversal in trend. So anything below 30, you want to be looking for opportunities to long or to buy in the market. I hope you understand this, and I will be showing you the RSI chart again and how you can use it. So this is RSI. This region is 70. This region is 70 RSI level, while this region is 30. Anything below 30 means oversold. Anything above 70 means overbought. At overbought, you want to be looking to sell. At oversold, you want to be looking to buy. So there's a midpoint which is 50. Anything above 50 is showing you strength in the market among the bulls. So if it's above 50, it means there are so many buyers in the market. Anything above 70, it means buyers are already leaving the market. Do you understand? So anything below 50, anything around 45, 40, 35 is showing that there are still so many sellers in the market, right, to push the price down. But anything that gets below 30, it means the sellers are already leaving the market, so most likely there's going to be a change of trend very, very soon. So there's a concept I want to talk about with RSI. There's what is called bullish divergence and bearish divergence. And what bullish divergence tells us is when price has been falling for a period of time, and oscillator, which is our RSI, is showing us that there's going to be potential uptrend really soon. When it comes to price action, if there's a downtrend, it means that we are forming lower highs. Remember our trend, we are forming lower highs when price is dropping. But if you see that in our RSI, we are forming higher lows, it represents that the sellers that are winning in the market with the price action, right? So we have two charts. We have the RSI chart and we have the proper price action chart. It's showing our prices and volume, right? So here we have been having lower highs, a downtrend. But if RSI is showing you higher lows, it signifies that the sellers that are winning in the market, that have been pushing the price down, are gradually leaving the market. Do you understand? Because price has been dropping, but we don't know when price will change direction. But RSI can show us when sellers are already leaving the market and the trend is about to change. Do you understand? So another example is for the uptrend. So let's say the price has been forming higher highs and higher lows. It means price is going up. But why price is going up? The RSI is showing us lower highs, lower lows, which represent a downtrend on the RSI chart. So when you see lower highs, lower highs, lower highs on the RSI, it means that price is about to start coming down, even though price is going up at that point in time. So here now, we started seeing lower highs, right? Even though price was going up, RSI started showing lower highs. It means even though price is going up, the buyers that are helping the price to go up are already leaving the market. So that is why RSI is showing lower highs, why price is still going up. Do you understand? So when you see something like that, it is called bearish divergence. price is going up but RSI is going down. So it shows that the strength in the market is already dropping. So you want to be a seller in the market at that point in time because price is about to drop. Do you understand? If it's a bullish divergence, it means that price is dropping, right? But RSI is going up. So RSI is forming higher lows, while price is dropping. It shows that we are going to see an increase in price or a change in trend to an uptrend. Do you understand? So when you see a bullish divergence, it occurs when prices fall to a new low while an oscillator, which is RSI, forms a new high. Do you understand? So you want to be looking for bullish divergence in a downtrend. So if prices have been falling, but RSI is showing higher lows, which means RSI has been going up. In that case, you want to be looking for a reversal in a downtrend to the uptrend. For bearish divergence, you want to be looking for that in an uptrend. It means prices have been going up, but the RSI is going down, which shows that the buyers that have been pushing the price up are already leaving the market gradually. So you too, you should be getting ready to leave the market because you don't want to be caught slacking in the market. So when you are using RSI, you have to stay patient, very, very patient. You have to look for the right overbought and oversold level for entry and exit in the market. So I hope you understand what RSI does now. You understand how to use the 70 and the 30 overbought and oversold region. You understand what bullish divergence is, and you understand what bearish divergence is. So let me give a recap. RSI shows how strong or how weak a trend is. Anything above 70 shows overbought. An overbought level is a price level where price of a particular asset is too expensive and there are no more buyers to continue pushing the price up. So at overbought level, you want to be selling, right? So anything below 30 shows oversold, and oversold means the price of an asset is selling too cheap. So when the price of an asset is selling too cheap, you want to be a buyer in that kind of market. So what is bullish divergence? Bullish divergence occurs in a downtrend, and it is when prices fall to a new low while RSI is showing new highs. So when prices are falling but RSI is going up, it shows that the sellers that are pushing the price down in the market are gradually leaving the market. So in the nearest future, there's going to be a change of trend to an uptrend. For bearish divergence, it occurs in an uptrend. It means price has been going up. That means there's an uptrend already, but RSI is forming new lows. So what this is telling us is that the buyers that have been buying to push the price of an asset up are already leaving the market. So there's going to be a change of trend to a downtrend. So that's basically all you need to know about RSI. And the next one we're going to be talking about is moving averages. It calculates average price of an asset over a period of time. So for example, let's say we have 8-day moving average. Let me show you what it looks like on the chart, right? So this is ATME, this line that you are looking at. This 8-day moving average represents the average price an asset is selling over 8-day period. If it's 18-day moving average, they calculate the average price an asset has been selling over the period of 18 days. If it's 200 days, that's how it works for it. So they calculate it over a period of 200 days. What moving averages do is they show us support and resistance. So for example, in this chart, this moving average has been serving as resistance. So price has not been able to break it successfully apart from this place. So price was able to break it here and then it went back below it, and right now it's serving as resistance. So until it starts serving as support, like this place, there was a place it was serving as support. So from here it started serving as support. So price started trending above it, and when price is above a particular region, that region will be serving as support. So it was serving as support from this region to this region until price broke it and it started serving as resistance. Do you understand? So it just shows us support and resistance in the market, and it usually follow the trend, right? So for moving averages, we use 8-day and we use 18-day. So you can easily do your settings here. You can go to indicators and then search for moving averages. Do you understand? But we use the exponential moving average because that one moves faster with the market. So you are going to click on moving average exponential. When you click on it, it shows you here. So you can do your settings here by changing it to 8. That's the length of the day. And then the star, you can change it to blue. And then for the 18, you click on it, change it to 18, and then the star, you can change it to red. These are the two EMAs we are going to be using for the chart on a regular basis. And the third EMA we are going to be using is 200. And what 200 EMA does is, when price is above the 200 EMA, 200 EMA will be serving as support, and it shows that there's a general upward price movement in the market. So anytime price is above the 200 EMA, it means we are going to be seeing an uptrend for a long period of time. Do you understand? If it's below it, it shows that we are going to see a downtrend for a long period of time. And when I say a long period of time, it depends on the time frame you are using. So for this daily now, when it was above it here, when it broke above it here, this was May, and then from May till now we've had uptrend. Do you understand? When it broke below it here, it took some weeks for it to break above it, and when price is below it, it means there's going to be a downtrend for a period of time. Do you understand? So that's what 200 EMA is used for. I also use it in my chart. You can also use it on any time frame. So there's what is called double crossover method. So double crossover method, it is applied to any moving average too when the short moving average crosses the relative long moving average. So the short moving average is our 8-day moving average, right? And the long moving average is our 18-day moving average. Anytime the short moving average crosses the long moving average to the downside, it means price is about to start dropping. Do you understand? When it crosses it to the downside, it means price is about to start dropping. But when it crosses it to the upside, so for example, here you can see the shorter one, which is the ATMA, is the blue, while the longer one is the red. So there was a time the crossover happened around here. It crossed above it here. So when the ATMA crossed above the 18-day EMA, it means that there is a crossover, and most likely the price will start to increase because both of them are now serving as support. Do you understand? This double cross method, it is not reliable enough to take trades. Remember that. Do not use indicators alone to take trades. It just helps as extra confirmation to take trades. Please, you don't want to be using indicators to take trades. So that's basically what crossover method does. For this area now, when the blue one, which is the 8-day moving average, crossed to the downside, can you see? It crossed the 18-day EMA to the downside here. It means what? There's probably going to be a downtrend very soon, which we had. Do you understand? So the 8-day EMA crossed the 18-day EMA to the upside here, which signifies an uptrend. So I hope you understand moving averages now, and then the